Welcome back to Go Gaddis Real Estate Radio. I'm Cleve Gaddis, and I'm here to make real estate clear and simple and worry-free for you. You're listening to us on AM 920, The Answer. And if you want to connect with us, it is so easy. Just go to gogaddisradio.com, GOGADDIS radio.com. You can ask questions that we answer on air or off air. You can challenge or push back on things we say. You can connect with us on our podcast or our YouTube videos. You can do whatever you want to at gogaddisradio.com. And I promise you, if you go to gogaddisradio.com, I will see what you say myself, and I will be the one who gets back in touch with you. Somebody else might call to set an appointment, but I will be back in touch with you, and it'll be so awesome. Those of you who were here for the prior segment know that we have Matt Scout, who is a really exceptionally good loan originator. I know that's not your title, but that's what you do. You're in the business of helping people figure out how to get loans. You've got some big title Absolutely. That sounds even more important, but like you're as down to earth as they come, and you're helping people get into home ownership or refinancing or whatever. And we were talking about the 30-year amortization for a mortgage versus a 50-year, and you and I both agreed in the last segment that it's a lot of it has to do with the optics, the political optics, meaning what is the government trying to do to make it more affordable. And I think ultimately interest rates are going to come down some, but you ran the rates for me on a $500,000 purchase, $100,000 down, 6.5% interest rate, which I think is probably doable today, amortized over 30 years. You came up with a payment of $2,528. Now, you and I do not know what the interest rate premium will be for a 50-year loan. I have read that the industry expects it to be somewhere between 0.5 point and 1 point. You and I chose to go with 0.75 points. So we're saying that if you did a 50-year mortgage, it would be 7.25%. Same $500,000 loan. Same $100,000 down payment, 50-year amortization at 7.25%. The payment is $2,483. So for those of you who are like, wait a minute, that's too many numbers, it's $2,528 for the payment on a 30-year amortization. It's $2,483, $45 less for the payment on a 50-year amortization. If you're out there listening and you're a mortgage expert and you think our math is wrong, try it and see if you can figure out where we might be off. But I ran some numbers during the break that blew my mind. I said, okay, for the 30-year loan, your example, 6.5%, what would the total of payments be if I made all my payments over 30 years? Okay, and that number is total principal and interest payments, $910,177.95. So let's just call it $910,000. That's how the total of the payments, the principal payments and the interest payments over 30 years.
Yep.
Now, you want to have fun for just a minute, Matt?
Absolutely.
You want to guess, and I hate to put you on the spot, or you can put me on the spot, but I already know the answer.
Oh, no.
What do you think the total of payments would be on the 50-year mortgage, if you just had to guess?
I'm going to guess 1.7.
Okay, I'm surprised you guessed higher than the actual number, but you're not far off. It's 1.490. So it's just under $1.5 million. So if you go with a 50-year mortgage, you spend $580,000 more.
Wow.
In payments over the years. So this is not a show for me and you to say you should or you shouldn't be getting a 50-year mortgage, because if the only way you can get into a property is through a 50-year mortgage, maybe you should do that. But my suggestion would be start making additional principal payments right off the bat. Like you should be making an additional one payment every year so you can cut 7 years off the term, or I don't know how much it would cut off the term. But what are your thoughts on that? If somebody really needs it to get in, do you support it?
So I think the way that you have to look at it is, how long is the average mortgage held?
I don't know.
Usually 5 to.
Is that what it is?
Because I was 5 to 7 years.
Okay.
So if you look at it as using it towards a vehicle of a 5 to 7 year term, I guess it wouldn't be as bad.
Right.
If you know you're going to be selling your house, refinancing it, what have you, in that period of time. Okay, it's just a lower payment. But if you're truly thinking you're going to hold on to this for 50 years, I wouldn't probably go that route. You definitely want to make an additional payment or two. It's just that's a lot of interest that you're accruing just because.
And at a minimum, if you got to where you could refinance and you go to a lower rate or a 30-year or 20-year or something like that, you should 100% do that. So, question for you. Let's just say you were moving to Japan.
Okay.
I don't know. Is that on your bucket list to move to Japan, Matt?
Not yet.
Okay.
But we can put it there.
Let's just say that you were moving to Japan. How long of an amortization can you get on a property in Japan?
I don't know.
100 years.
Wow.
So it's interesting. We're not the only country that is trying to be able to figure out how to make housing more affordable. I'm assuming they do that in Japan because they feel like they have to in order to get their citizens where they can actually afford to buy a house.
Very interesting. I would not have guessed that.
So you tell me if you agree. I believe that all of this is being driven by skyrocketing home prices and wages that are they're not keeping up with. I mean, wages until the last 10 years were really flat. For 25 years before that, it was quite amazing. You agree with both of those things?
I would agree, absolutely.
So inflation and high interest rates is squeezing affordability. And I think it's just lenders and policymakers, politicians looking for creative ways to extend affordability for everybody who might want to buy a home. Why do you think it is, Matt, that the government wants to encourage people to be homeowners? Because they do put tax incentives in place, meaning I can deduct my mortgage interest, I can deduct my property taxes up to a certain limit. And you can as well. And so the government really tries to incentivize people to own homes. And maybe this is a question that's too honest to ask for the radio or anywhere else, but why do you think they do that?
I don't know if I could answer that. I know that owning a house is the American dream. So if I had to guess, that's kind of the route that they're going towards. But I'm sure there's some underlying incentive there for the government.
You know what I think it is? Would you be interested in hearing my answer?
Yes, please.
I think it creates stability. When you put down roots, anything that makes it where you're a little more permanent in the area where you are, I think it creates more stability. In other words, I think it's possible that you're a better community citizen when you live in a place that you own. And I'm not trying to say people who rent are bad. I'm not trying to say that at all. I'm just saying people who rent don't necessarily have as much of a long-term view on where they live as those who own.
Yeah, that makes perfect sense.
And so I think it's designed to create stability. So why is the government involved in the mortgage business in the first place? And how does that work? So in other words, how can the government decide that lenders will now loan money for 50 years? And this is not a trick question, just very simple, because most people don't understand it. How does that happen?
Well, in general, the government is the one, or the Federal Reserve is the one that is lending the banks money to be able to do business.
Right.
So they can, in one way or another, dictate what is allowed and not allowed.
Yep. And in most cases, I think up to 70% of the mortgages in the United States are insured by the U.S. government because Fannie Mae and Freddie Mac used to be publicly traded companies. Ever since the recession, they have been in conservatorship, and they're still owned by the U.S. government, which means whatever the government policy is, that's what Fannie Mae and Freddie Mac have to do. So that's how the government is able to control interest rates. Hey, tell me if you will, Matt. I would assume that you talk to people all of the time who are not quite ready to get a mortgage. And my question for you is, for those people who are not quite ready to get a mortgage, what is it typically, and I don't want you to give me anybody's information, but what is it typically that's holding them up that they need to work on in order to get ready?
I think typically it's either going to be their credit.
Okay.
They still need to work on a few things to get the credit score up a little bit higher to qualify.
Okay.
Or they don't have enough money saved for a down payment.
Got it. And what is the minimum down payment someone can make? They can make zero if they're a veteran. They can make zero if it's USDA loan, but on average, the minimum is 3.5, right?
Yeah. So conventional loan minimum's 3.
Yep.
FHA loan is 3.5%.
Yep. So before we get off the 50-year mortgage, you and I think both agree that doing a 50-year mortgage is not a smart financial move. And
I agree.
If you had to do it in order to qualify, then you would want to do it and have the goal of getting rid of that mortgage or refinancing or doing something different within a few years, or at a minimum making an additional payment. So let's say your payment was $2,500, then maybe you pay an extra $200 a month, and then that way every year you will have made one additional payment. On a 30-year note, 30-year amortization, that cuts 7 years off the payments. So let me ask you one quick question. Over the last few weeks, the government says, hey, no longer are we requiring minimum credit scores. It used to be 580, I think, in order to qualify. Is that going to really make much difference, and how does that work? We've got about a minute and a half left in the segment.
Yeah, it really shouldn't make too much of a difference. Even though they're taking the restrictions off, you still have to get an approval in their underwriting programs to be able to get a mortgage. So let's say someone comes in and technically there's no restrictions. They have a 500 credit score. They're not going to probably get an approval, but the government's saying there's still a chance, depending on what they put down.
So what if they had a 500 credit score, they own their own business, and they had a 50% down payment for the house? Could that make a difference? Because they're only financing 50%?
Yes. Having that much skin in the game, that could sway things a little bit more.
Okay.
Looking at what are their reserves in the bank. If you have a large down payment plus a lot of extra money in the bank, you're a lot less of a risk to the bank and to the underwriters.
Interesting. Matt, if somebody wants to reach you, they can either go to gogaddisradio.com, click on Contact Us, say, hey, have the mortgage expert call, or how else can they get you?
Yep. You can text or call me at 480-636-6762 or email me at matthew.scout@southeastmortgage.com.
Matt, this was fun. Thank you so much for being here today. We're going to take a quick break. When we come back in our Neighborhood Spotlight, we're featuring Ashbrook in Cumming. And are you really ready for the holidays? We've got a little quiz for you, and we're going to tell you where to find the most beautifully designed holiday home in all of Metro Atlanta. Stick with us. We'll be back.